Everybody, happy Thursday. Thanks for joining us for our monthly Flex series today. Before we get into it, I'm really excited about our guest speaker. We've had him on before. A lot of us at Flagstar get to work with him on a daily basis. At least I know a lot of us do, like myself. And I'm really excited to kind of have him share some thoughts and ideas with you today. But obviously, as I said, right, welcome to the call. Appreciate you taking the time to join today. And as always, hopefully everybody is doing well, healthy, safe. I know we've had some recent holidays and Passover and Easter, and spring break seems to be a little bit different everywhere throughout the country, but I think everybody's probably had their spring breaks by now. So hopefully you got to spend some time with family, friends. If you're like me, got to see my college, your kids that are off at school coming home or vacationing with you somewhere. So hopefully you've enjoyed that over the last couple of weeks. And then obviously with all of what I would say classifies kind of the natural disasters that we've seen recently, hopefully if you were impacted by that at all, or your friends, family, loved ones were, hopefully everybody's safe and doing okay. And if, obviously thoughts go out to everybody in that regard. So, but hey, so one of the things we do, right? We try to bring value to you as a customer, as our business partner. And I think you've seen us, we've dived into a lot of different topics, right? But I always like to come back to every, 60, 90 days, what's actually going on in the marketplace, right? And if you remember, I think we started off in January with Josh Pitts, and it was kind of more on the social side and drilling into like getting started and getting referrals and looking for getting production in the door. And then in February, we had Dave Stevens, and he kind of gave a holistic look at kind of mortgage and what we were going to be faced with. And then last month, we had Joe Wilson, who's a friend of Flagstar's, and really kind of drilling further into social. And I really like kind of what he talked about in regards to like how you can find referrals and how we actually walked you through that. And I know he got a lot of follow-up conversation with a lot of people that attended. And then this month, I want to go back to the market because now we're in Q2, we just started Q2. We're coming out of Q1 and Q4, obviously. And our next guest, who I'll introduce now, is going to kind of talk a little bit about where we're at today, what challenges we're still seeing, kind of what the market is telling us, what maybe the Fed's saying versus what the market's thinking. And then really kind of wrap up with, okay, but like, what does this mean as we go forward, right? Because I think a lot of times we feel like there's all these headwinds against us. And really, if you look at it over time, the momentum is building. So I'm excited about our next guest. He's been on before. If you don't know him, his name's Jason Lee. He's 27 years, mortgage veteran. He's a lifer. He's been doing it straight out of college. He's held multiple roles with a lot of key large lending institutions, successful institutions throughout the last 27 years. At his role at Flagstar, he's the senior vice president of capital markets for us. And like, quite honestly, secondary markets, that includes, everything from any of those activities related to the capital markets, including trading, hedging, marketing of residential mortgage-backed securities, pricing, margin management, loan delivery, you name it. From a secondary market side, Jason kind of oversees it for us at Flagstar. And then before joining Flagstar, he was at institutions like North Point and Caliber and Quicken and Freedom, to name a few. So with that being said, hey, Jason, come on out. There you are. What's going on, man? How you doing? Hey, you're on mute.
3 years into this, I'll get it one of these days.
Hey.
I'm doing well. How are you?
Good, man. All right. Before we get going, and of course, like I mentioned on all these, if you have any questions, right, if you just go right down below, put those questions in, we'll either answer them along the way or we'll get to them at the end. But before we get started, what's going on the wall behind you? What do we got going on there so people can understand what they're looking at?
Yeah, I should have blurred my background. I kind of like a lot of people in the United States, I hopped on the fanboy F1 bandwagon because of Netflix. I blame Netflix. So the guys here picked this up for the holidays for me. It's the Circuit of America track from Austin, and then there's a little car underneath it too. But pretty cool little handmade present for the holidays that I thought was kind of fun to put on the wall, something different.
Yeah, I knew what it was. I wanted everybody else to know. And thank you for now my little fandom, because you got
Yeah.
me into the Netflix series. So now my wife appreciates that I'm watching another sport on TV. So she'll
Right.
thank you next time she sees you.
Right.
Well, hey, man, I appreciate you doing this. I know you've put some slides together. And like I mentioned in the intro, right, we're going to talk a little bit about where we're at today, what's changed, what we're seeing, and where we're headed. So why don't we get started?
Yeah, let's do it. So, like you said, put a few slides here. Really, my goal is just to kind of let's walk through what's happened, what's happening, and then, like you said, let's go into a little bit of forecasting, maybe a combination of crystal ball and magic 8 ball at the end here, and see where we're heading here into 24. But this first page illustrates the major product types that we all deal with on a daily basis, right? This is 95% of what we do as an industry outside of the non-QM space. So FHA, VA, and then your conventionals, and then your non-HC jumbo. You can see from 22 in January, it's just the drastic, visually, this kind of makes your eyes pop out, how fast, and, we're all aware of it, just the tear to the higher rates that we've gone through here in the last 16 months, right? And one thing that's kind of interesting to point out, a couple things actually. The 15-year, which is the red high bar there on the bottom at the end, these bars represent the change in note rates to the consumer, and these are actual note rates that the consumers experience from January 22 versus what they're able to get today if they walked into any of our partners' stores or made the phone call. And that 15-year kind of stuck out to me because we have this inverted yield curve, right? These shorter term rates are reacting to what the Fed is doing, and you have the smaller, shorter terms have a higher rate, which is kind of hard to wrap your head around. But that kind of shows clearly here in the bottom of the bar charts of, almost what is that, 315 basis points higher than they were back in January 22 compared to 300-ish, a little less than 300 on a 30-year. The other one that's interesting is the jumbo. We've had some major players leave the space. We've had disruption in the private label securitization market, right? And so the jumbo borrower 14 months ago was roughly 3.25 lower in rate than they are today. And that's just, it's staggering to think about that, right? I mean, over double what we were seeing in January. So a big move from 3 to 6.25. And, that really cuts into affordability, and you name it, you go down the line of how that, is kind of a domino effect and everything.
Yeah. So Jason, 2 questions for you. I want a comment to get your thoughts on, and one's a question. So when you talk about disruption in the private label securitization market, can you just go into a little bit, maybe deeper dive on that for some of the people on the call?
Yeah, I think the best way to kind of understand this is to take a step back and what is the investor in, outside the U.S. government and Treasury and what they did with easing and buying MBS and mortgages. But what is the institutional investor looking for? And they're looking for duration and cash flows on the money that they're investing. So if I'm allocated X amount of money for my firm to go invest, I want to model that out and say, hey, I expect, for this conversation, make it easy, I expect 5 years of cash flows. If I'm going to pay, 102, 101, 103 for this loan, I expect it to be around till 2028, 2029, right? And when rates get this high, from a historical perspective, especially in the last 15 years, we're seeing the highest rates we've seen in a long time. They get nervous, and why? If I know, and we'll get to this in the later slides here, if I'm pretty sure and I'm pretty certain that we're starting to see the economy cool off, and we know that the Fed will reverse its course once we start seeing it really start to taper off, and you can argue soft landing, crash landing, whatever you want to say, but there will be a time where we'll come back in, we'll hit that bottom, we'll hit the trough, right? And then they'll start to have to cut, and rates will start dropping. And so if I'm a money manager, why am I going to invest in a 6.5 jumbo rate when I'm pretty sure with certainty that these rates will be lower next year? And you're talking about borrowers with high income, the ability to refi very easily, and with the higher balance, if you think about it, even an eighth or a quarter rate can mean a lot. It could be a meaningful number in a monthly payment. If you're talking, $1 million, $2 million plus loan, and they'll refi, and you'll see your investment evaporate, right? So if you were planning on investing, $10 billion into private label securitization market, and you modeled it out to be 4 years and it evaporates in a year, it's going to be bad news, especially if you paid a premium for that. And
Sure.
So that's what we're seeing is it's opportunistic buying. And what if you do read the industry magazines and publications, you see some activity there. And what it is it's really forced sellers selling seasoned loans for whatever reason they have to, and you can see that by the note rates that are in those deals. And JP Morgan is a pretty good issuer on that stuff. I think they've issued almost every month this year, but it's all seasoned and it's all 8, 10, 12, 18 months old. It's not new production. So they're picking up some of this aged inventory from other banks or forced sellers, independent mortgage bankers, maybe if they were hanging on to some older stuff. But there's really not a lot of new being produced because the levels just aren't there right now. And like I said, it's really just it's the vulture guys. It's the guys that want to buy bonds at 80 cents on the dollar. And they're going to model that out and say, hey, you know what? I'll pay 80 cents because I know this thing's probably going to potentially pay off in the next couple of years. So, they're making the play of the more payoffs, the better, right? Because then I make 20 points immediately because it's going to pay off the par.
Well, I think that's the conversation I wanted to have you kind of go into a little bit, because I think a lot of times when you look at specifically that jumbo market, I think there's a lot of questions on, from individuals, business partners as to why are we in the position we're in. I think that's a pretty good 30,000 foot level of why right there, right? Just think about it for you personally. If you were going to invest 5 million or 10 million of your own funds, you would want to deploy that for the duration or a longer period of time where that cash flow is going to return because you're getting a greater return on your equity versus if I invested that 10 million today and it ran off in 6 months, 7 months, which we'll talk about, towards the tail end of what we think the future is going to look like or what it may look like from all what you are hearing from all the economists. Hey, Jason, the other thing I was thinking too is I know it would be cool if we could do this. I don't think we can't do this now, but if you took all the up top, the line charts, and you took everything off but the conventional 30, right? The 30-year fixed, which is the black line. So I'll tell everybody watching this, try to train your eye on just the black line right now. Yep. If you went across and looked at a 40-year average and just straight lined where 30-year fixed were, they're probably right in that 6.5%, 7% range over the last 40 years, right?
Going back to the 80s, yeah,
going back to the 80s. So historically, we're probably below where we normally were. We're just coming out of an environment where rates were so low for so long that obviously it's put a pinch in the overall size of the market.
Yeah, we're pretty close to early 2000s range. Coming out of the dot-com bubble and all that. 2002, 2003 we're pretty close to those levels.
All right. Well, hey, that's product, right? I think that's a good start. What about kind of inflation, bond market? I think that's what we want to kind of go into next, right?
Yeah. So we can touch on this a little bit. Another just very simple graphic to kind of give a visualization of where we've been, where we're going, and what's happened here. And so you can see we had, I think we all know we've had relatively cheap money for a long time, about 15 years or so coming out of the financial crisis. And the target, the line in the sand that the Fed has really subscribed to for quite some time now is a 2% inflation target. And we've done pretty well maintaining that until coming out of COVID, right? And so that January, that second quarter of 21, things just really started taking off and heating up. And that's what triggered the Fed to step in and make all the changes and the rapid hikes that we've all experienced. And this just crazy, rapid rise on the mortgage rates as well. And so the other two highlights I'd like to kind of point out here is the first Fed hike, which is, it feels like it was yesterday, it was already over a year ago, right? And and they've done quite a few, and it's hard to wrap your head around that prime is 8%. It's still kind of just wild to even see that on a screen. And you think about other assets out there like credit card debt, that price off prime. I mean, it's just I don't know. It's not sustainable to have a 28, 29% credit card rate, and folks are going to start using their credit cards more, which is already happening. And then with the quantitative easing ending around that same time period, right? So it's working. What they're doing, it's happening. And this is really the CPI, the PPI, right? So consumer price index, purchase price index, and then the personal consumption expense, which is what it's really exactly what it sounds like, what prices consumers are paying. And so we're seeing that finally start to taper down. PPI came out again today, a little lower than expectation. So momentum is there. We're not quite out of the woods yet, but we're getting pretty close.
Yeah, it's interesting, right? I think you and I were joking around about this the other day. You talk about a soft landing, a crash landing. There's going to be a moment in time, right? And you mentioned it a little bit earlier, through maybe the Fed's actions, through, maybe just reactions and from the market in regards to certain things. But eventually we're going to get to 2, or at least somewhere in there, right? You would have thought with maybe some of the recent crisis, you could argue it was 2%, or until the system breaks. You could have argued potentially, I think some pundits argued that, well, if that wasn't a signal of the system breaking, what was? And I know we're going to talk a little bit more about kind of the Fed and what their thinking is around future state of continue the path. But I mean, at some point, we're getting to a point where this is going to not be a rate hike situation. We'll admit that we're in a recession at some point. And then, as you mentioned earlier, after every recession, you can see property values go up. It's historical, right? Just look at the historical trends. And we're not saying this isn't my opinion. I'm looking at like the last 8 times we had a recession. Value of your homes go up, rates come down, because what's the Fed going to have to do? They're going to have to turn around and start dropping rates to, spark the economy at that point.
Yeah, that's right. And so, living through, like you have, right, a few of these different cycles, it's going to happen quickly, and it'll happen like on a Wednesday, and we'll come in and it'll be boom, Fed, 25 emergency drop, 50 bit emergency drop. And then we'll be right on our way to the next cycle. Right. So it'll happen just as abruptly as things started going, the opposite way for us. They'll head the direction in fairly rapid manner.
Well, I think that's a good lead in, right? With the conversation around the Fed and some of the things we're seeing. I know there's something you're going to talk about here, which I'll hit on too, just to re-emphasize it because I love it. But there you go, right? What's the expectations? That there's multiple sets, right? We're hearing one thing from the Fed. You're hearing one thing from, what I call Wall Street or the market. And then you have all the pundits in between that try to decipher all that stuff. So here's a perfect lead in for you. Yeah,
and historically, nobody's really right 100%. So you kind of got to split the diff, right? So the Fed plot is dot plot is interesting. So they asked the different Fed governors to plot out where they feel the rates will be going into the future quarterly, and this is indicating that they still are going to hike another 25, and it's about a 78% chance that it will happen in May, right now anyways, as of we're sitting here right now. The market's indicating maybe they won't. The market's saying, hey, we might have 2 to 3 cuts by the end of the year. But the current policy rate it still stands, and Powell is still holding the line of, hey, I'm going to keep going. We're sticking to policy. We're going to ignore all this noise about the banking industry, and there's more factors to it than just what the Fed has done in raising rates. There's other mechanical things that are maybe need to be fixed or addressed from a regulatory standpoint. But when it comes to the economy and the inflation, the Fed they're gonna operate autonomously, and they're gonna go by the data. And I think, personally, I think we've got at least one more hike, maybe 2. we're just not seeing. We are seeing that momentum, but I don't think it's happening as fast as they want to. Right? We're in month 13, month 14 of this in this hike environment, and I think they want to see it start to move a little faster. But that's just my opinion. Like we just talked about. It's a very delicate landing that they're trying to achieve, and I don't know. I think the concept of a soft landing is a misnomer. I just don't think you can do it. I think, to Powell's credit, I think he's stated they're going to break things. Things are going to break, and there's going to be pain, and there's going to be pain at the consumer level. There's going to be pain at the corporation level, and that's just what we have to get through to get this economy cooled off and back on track to that 2 target.
Yeah. So, couple things for you just to kind of get your thought on it, and maybe a comment too. So, well, before I do that, one, I love the dot plot. Can you just go into a little bit more detail so people that may have never heard of that before or haven't paid attention to it? What is it? What's the makeup of it? What do they do? How's it derived? Can you just walk people through that real quick?
Yeah, it's kind of. It reminds me of the old Pong game a little bit when you look at it. we could have put it on the screen, but it literally is as simple as it sounds, right? And so it has, along the x-axis, it has the quarters of the year. Along the y-axis, going up and down, is where that rate, that policy rate will sit. And there's plots by governor on those quarters of where they think throughout the future it's going to be. And they, for the most part, they kind of align. And you've always got your kind of outlier somewhere. One of the governors will be a little bit of a naysayer, or maybe a little more aggressive or optimistic than the others will be. Typically, there's usually 1 or 2 of those folks, but it's pretty interesting to see how they're thinking and how it ebbs and flows over the next 8 to 10 quarters.
Yeah, I think to your point, right? There's always 1 or 2 bullish or dovish, right? If you want bullish or bearish, if you want to call it that. But it's always interesting to me because you're right. The majority of them are right within a range, but I think it's kind of gives you I think you've said it before. It's and maybe I'm phrasing this wrong, you can rephrase it, but it's as transparent as it's been in a very long time on what the thinking of from the Fed governors on what the next decision looks like. I think you said, as we sit here today, the one in May is a 78% chance of a quarter hike. Well, if you look at the dot plot, I guarantee you, of all the governors, probably close to 80% of them have us raising rates by a quarter in May.
Yeah, that's right. And I think that's right. The insight and the transparency that we've seen from this Fed has been, it really has been extraordinarily transparent, especially on the dot plot piece. And it's, I think it's welcomed by the market, but it's also can drive the market a little crazy because they read between the lines. And if you do read the Fed statements when they come out, they literally take a version of the previous statement, and you can take a version of the today's statement, and you can kind of redact. Okay, they took this one word out, they took this one sentence out, and people will spend days trying to say, okay, well, they took this one word out. What does that mean? What do they see that we don't see? And that's a little bit of the craziness that goes into the market now, trying to infer what they're meaning by removing adjectives or if-thens kind of thing. It's pretty wild, but I think the transparency is very welcome by the market.
Well, and I think your last statement bears out on the chart, right? Like the dot plot from the governors is telling you at least 1 more hike of a quarter in 2023. Yet what you just described taking place in the market with all the analysts and investors dissecting it, they're factoring in 2 cuts by the end of the year. By the way, we might get 1 more raise, and we still might get 2 or 3 cuts by the end of the year, right? It could literally happen where both things come true, or we get 1 raise, pause for a moment in time, and then there's 1 cut between now and the end of the year, right? So
yeah,
I think it's just interesting because everybody tries to forecast and predict, and I don't know, to the best of anybody's ability. I think we have pretty good insight into what the Fed governors are thinking.
Yeah, for me, I think, personally, I've got some of my, I guess what I call a canary in the coal mine kind of indicators in my head. I look at subprime auto debt, how that's performing. It's starting to struggle. that's usually a pretty good indicator that we're turning for the worse. Credit card debt is skyrocketing among your 30-year-olds and lower. So your younger generations are starting to rack up some debt. And that's, you could probably attribute to that. They've burned through the COVID savings. Maybe some of them actually become homeowners, right? Because that 30 mark is really your formation of household kind of range of age. So maybe they bought a house and now they're racking up some debt to furnish that, or, whatever the case may be with the home. So you're starting to see that happen. And then also you're starting to see savings go down as well, household savings. So all those kind of little tiny micro ecosystems are starting to add up, and I think it's coming. And then if you layer on some of this, certain sectors of the economy are starting to make some massive layoffs, not including us, right? Including the mortgage business. So you're starting to see it happen. And I think it's, there's always a delay on this, and we'll look back and say, oh yeah, we actually did start a recession in Q1. We just didn't know it, or didn't come to grips and admit it that we were there yet. But
yeah, we just weren't admitting it, right?
Yeah. Yep.
What I think, to your point, and I meant to say this on the other slide too, when you're talking product, everything you just mentioned, I also think that's why you're seeing two things happen in the marketplace right now. When we get the little mini rallies, right? And I think we'll talk about applications here in a second. We've seen, and I know it's not just us, so it's market driven. We've seen the number of transactions, or the percentage of transactions that are cash out refinances, significantly increase. And then on top of it, if it's not that, if you just look from an industry's perspective, the HELOC HELoan has become a product that is, predominant in the marketplace, with a way to kind of do the cash out, keep your low interest rate, take out the HELOC, pay off debt, do a debt consolidation at the table by paying off your debt. You're starting to see that. Well, not starting to, it's been generating, and kind of that momentum has been building for quite some time now.
Yeah, I think that's all accurate. I mean, it's, we definitely, cyclically, we always see some cash out spike after the holidays, right? Everybody goes a little overboard with trips or gifts during the December timeframe. So Q1 definitely always, historically, we see, just no matter what the market is, we'll see a little spike there. But yeah, to your point, consumers are locked in. I mean, they're not going to move away from that 3. And, if I can take a HELOC at 10 or 11% and pay off my my credit card debt at 25 or 29%, it's going to put me in a much healthier position. And most likely that'll be an IO payment as well, right? So
that's right.
As long as they don't rack them back up, that's the issue, is, you still have the 25% to go right back to charging the cards back up.
That's where you get in trouble, right? You hold on to the 3% mortgage, you consolidate, you've freed up cash flow on a monthly basis now by paying off your 25, 28% debt. But then you go back and run up to 25, 28%. That's the worst case scenario, right? Because now you're leveraged as a borrower in a time where everything's pointing to, we got a little bit more pain to go through, right? From a standpoint of cost of living and inflation and what things are going to cost.
And I think there's still some life events happening. People still get married, get divorced, upsize, downsize. There's reasons why they're refinancing or need cash out that are outside of maybe market-driven forces. And maybe it does make sense to cash out at 6.5%, even if you have a 3. Maybe you're not going to be in that home more than 2 years. And then why am I going to pay 11 if I know for sure I'm going to be out of this house in 2 or 3 years? My kids are leaving for college and I'm downsizing. So it's really, I think that's when it gets down to, especially with a lot of our partners, right? It's that local lending, knowing your consumer, knowing your market, and, what the folks really need for their own particular financial, situation. It's really a custom thing between the lender and the customer, as far as, hey, this is what I really need the next 2 to 5 years. And I don't want the prime plus 3% HELOC. I'll just take a 6 and I'll live with it, because at the end of the day, my cash flow is going to be better and my credit card is going to be gone, and I'm going to be in a good situation while my kid's in college.
Yeah. Hey, look, we say it all the time, right? That's the difference. That's where the business partner, knowing their borrower, right? That's being their financial partner or financial consultant for life, right? Like, at the end of the day, are they thinking about you? Are you having check-in calls with them as their financial, consultant from a mortgage perspective? Are they looking at doing a HELOC or, with their local credit union? Well, guess what? maybe that isn't the best option for them. And maybe your phone call on that monthly basis, touching base with them just to see how things are going, leads you to a refinance, because that's a much better situation for them than taking out a HELOC. Or maybe it is taking a HELOC, and instead of letting a bank wedge themselves in between you and the borrower, you insert yourself back into that conversation because you have outlets to do HELOCs, right? So I think it's a good point, right? It's just the value add that you bring as a professional to your client base as a continued consultant.
Yeah, that's right.
So I think kind of the next lead in would just be like, okay, here's where we're at. This is what they're thinking. And then let's see, like, I think you have a little, yeah, there you go. I think you have something on kind of like weekly MBA stats.
Yeah. So this, looking through different various stats and what we track here, it's a weekly and then a 4-week roll. And on the top there, top left, you've got applications. And I think we all know it's, we kind of hit the bottom in January of this year going into the holidays. We had a little bit of a reprieve, and it's really going back to your earlier comment. We get these little mini rallies on a Tuesday or a Wednesday, and we'll see an 8 tick or a 25, 30 basis point rally, 40 basis points here, and then boom, we'll get some apps. And that to me indicates, the consumer is pretty savvy, and I think they're working with their lender partner and say, hey, I might be on the bubble as far as affordability and bumping up against, the house that I want, the price range that I'm looking for in my payment and my debt. And that 40 basis points in price might be the deal. And so I think that's what we see is we've got some guys waiting and they're in the wings, and they're doing, they're being proactive and watching the market for their customer. And when that happens, boom, they take the app and we're off to the races. Right. And so we see that little 1-2 day, 3-day spike, and then it'll go back to kind of quiet. And then boom, we'll see another little spike here or there. It happened for like a week. Was it second week of March? Maybe we had a little bump there. We saw some pretty big days here at Flagstar overall over all of our channels, really. The purchase index on the right there, I think everybody kind of gets that right. It's we're starting to see the purchase market climb back up here going into the spring, summer. Schools will be getting out, so I think you've got some folks, getting in front of the wave of home buyers and starting to look at homes and think about their next move going into summer break. And we're heading into the prime buying season here, so we see that tick up there at the tail end. Refi index, not much to talk about here. We kind of covered that already. And then the purchase refi mix, I think that's the same thing. We all know what's going on there. I mean, it's a purchase market. There are refis to be had, and I think it's a really custom situation for your borrower. If it makes sense for their needs, then I think there's nothing wrong with taking a cash out refi in here if it fits the needs and where you're going in the next 2 to 3 years. And we see some lenders really focus on that. We watch the market and which lenders are doing refis, which lenders are doing purchase business, and we can see that the call centers really focus on refis, which inherently we all know that that's what they do. That's their bread and butter. And some of the call centers, they're out indexing the market on cash outs by almost a 3 multiple, about a 3 mul on some of the bigger call centers. So there's business to be had out there on the cash outs. It's just, if you can find those consumers that it makes sense for.
Yeah. And look, gang, I think if you look at these charts, right, if I look at the top two and the one on the bottom left, the refi index, right, if you layered in kind of like a vertical line going back to, I think it was March of last year, Jason had on a different chart of when the QE kind of easing ended, when the first rate hike happened. And then if you layered on every rate hike after that on this chart, I think those things would, the kind of trajectory of the charts shouldn't be earth shattering to anybody, right? What I look at is kind of as you get into 23 and now you're into February, March, into April, you can see, at least on the purchase side of the house, as Jason mentioned, not only is it that time of year, right, which would be the traditional summer purchase market right around the corner, but you're continuing to see that trend of an upward trajectory. And even refinances, right? Like, granted, it's only a blip, but Jason's made some compelling points that it might make sense to take the refinance and do a cash out. Again, life event, consolidate debt, whatever it may be. Because again, at 6, you might be in a better position than keeping 3 and taking an 11% ish, HELOC type of situation. But you can kind of see the bottoming out, right? Like, so for the way I look at it is like, look, none of us have a real true crystal ball, right? But if you kind of think like we're getting to the trough or to the bottom of the cycle, then the question becomes is like, when do we get to the next part of the cycle, which we all know is coming, right? Like if we've been doing this, I know Jason's been doing this 27 years. I've been in it 26, like a little longer than we have. You've 4 or 5 years of low interest rates and sizable market. And then we go into what is recessionary times or inflationary times. And, things get kind of tampered down a little bit. Rates go up, volume comes down. Well, when you come out of that cycle, the way you come out of it is what we've continued to talk about. And I think, Jason, that's your next slide, right? Which kind of talks a little bit about, okay, here's where it was, here's what's happened, here's what we're seeing today, and then what does the future hold?
Yeah, so that's exactly right. It's back to the future here. So we've gone over kind of what's happened, where we're at today. So what does this all mean going forward? And what's I kind of started off with the crystal ball / kind of magic 8 ball, right? So if you look at Fannie, Freddie, MBA, and Moody's is kind of who we track here. These guys got all the economists, they got the guys with the little spinners on their heads and stuff, right? So they're figuring out, they're modeling this out, and we track to it, and this is kind of an average or a accumulation of all their data and kind of where it tracks on an average basis. So you can see we're starting to kind of pick up coming into the summer here. These numbers are probably pretty close to what's really going to happen. And these are in billions, right? So Q2, we're looking at that 460 billion and rising up a little bit in Q3 and then back down. Q1's probably going to be tough. We're heading into an election year. There's just a lot of things going on. Depending on when the rate cut starts happening, could be Q1 of 24, maybe Q3 or Q4 of 23. But next year, anybody you look at, any economist that is publishing this data, they're saying that we're going to head back towards the $2.2, $2.3 trillion market, versus this year where we should probably most likely end up around a $1.7 billion market. And this is going to be attributed to the refis. I think it's, depending on who you look at or who you subscribe to, Fannie, Freddie, the MBA, and Moody's is somewhere between 17 to 22% refis in 24. So that opens up a huge window of opportunity from a rate and refi rate and term refi. And you're looking at, going from mid 6s today to maybe, probably mid 5s, maybe lower. That's a pretty substantial pickup in savings for the consumer to get locked in and lower their monthly costs there. And it could be more. I mean, we could see rates drop a little lower faster, depending on how, like we've talked about, right? Is this a soft landing, crash landing? How hard is this going to bottom out? And if it's a crash landing, if it's a tough landing here, I think we could see this go a little lower. But this is where we're looking at right now with all the data, and I guess the best of the best guys out there that are modeling this. It's a pretty significant pickup. So $500 billion that's a lot of business for us all to share in.
Yeah, and I think to your point, right? Like, 1.8 trillion this year into, the 2.2, 2.3 range next year, which again, so Jason reiterated, right? This chart's a compilation of all those Fannie, Freddie, MBA, and it's, not only is it the refi pickup, but if you actually break it down into the purchase versus refi, there's expectations of growth in purchase too. I think to Jason's point, where you see the significant pickup is now the refi market comes back, right? And look at the top chart, right? 6.7 down to 6 in Q4. So year over year, 6.7 to 6, and then year over year, 6 to 5, and I'll round it up, call 5.25, right? we've all been doing this a very long time. There's a benefit to the borrower to refinance. And you've heard a lot of people say it, right? Like, I still think now is the best time to buy a home at the end of the day, even though rates have ticked up. We're not going to do it today, but you could go into so much of the loss of creation of wealth by waiting, the miss out on appreciation that you'll gather, the return on your investment, and then factoring in that you'd be able to refinance from 6.5 to 6 to 5.5 and save yourself money over time while not missing out on the appreciation and the equity that you're creating in your home. But let's face it, we've all been doing this a very long time. This is the cycle that's going to happen, right? We're going to have high rates. People are still going to buy homes. And then at some point, we're going to reverse course because we're now going to be in a recession. We're going to cut rates, and you're going to see values, probably climb in homes. Maybe not at the levels we've seen in the past, right? But you'll see some appreciation, and then you'll see rates come down, and people will be able to save, and affordability will be a better position for them by doing a refi.
Yeah. And the top chart's a little stale already. I mean, it looks like they already had the rates wrong. So they missed they missed Q1. I mean, we're at like a 340 10-year right now, anyways. But yeah, I think this is not an exact science. This is a guesstimate, a best guess with the data that they have and where they think it's going based off historicals. And it's a guide, and it's not gospel, right? So
that's right.
It's definitely going to be, there's one thing you can say: this next year, 2024, most definitely, 90% chance it's going to be substantial volume pickup over this year.
That's right.
Where the rates will be, it's anybody's guess, but they're probably close. So I would say if I had to, if I were modeling this out, I would probably come out with a very similar, that low to mid fives. I think that's probably spot on where I would guess it to be. But give or take half a point off that. It's hard to guess till we get there. And everybody, we all, it's human nature to get caught up in that myopic living in the moment. Just like when we had a $4 trillion market, right? Everybody's like, this is going to last forever.
That's right.
But if you think about the trillions of dollars of purchase business you guys have been doing for the last couple of years, I mean, that's trillions of dollars of potential refis in the next few years. So you're only building a book of business for the future, and it's going to be there. And 2 or 3 years or a year, 18 months, like we talked about, people's lives change, and there's going to be a need for, conversations around what to do here and if it makes sense to do a refi. So.
Yeah, and we focus a lot of times on like divorce and things like that, but it's the other life changes too, right? Two independent households become one. People get married, they buy their first house, they have their first, second, third kid, right? They need to expand, like from a standpoint of living space. There's so many things that are going to happen. And look, I think you've heard a lot of people say it. Jason said it today. Dave Stevens said it on our session in February. If you follow Housing Wire or Barry Habib and MBS Highway, you continue to hear it, right? Everything that you're doing today is just level setting for, some people call it the next run, call it what you want, right? But it's setting yourself up for 24 and beyond, because the data tells you that at some point, to Jason's point, maybe it's a half a point or a quarter point here or there, they're off by slightly, percentages. It's coming, right? And I think one thing Jason said today is we're still got some pain to go through, right? Like that's still going to happen. There's still going to be some volatility. Private capital is still going to sit on the sidelines because they're looking for duration, like we talked about at the beginning. And look, there's other things that impact what we do on a daily basis. But everything you're doing now is setting yourself up for the future. And the one thing I continue to say to everybody is like, at the end of the day, there's some core things that never change. Are you staying in touch with your client? Are you staying in touch with your borrower? Are you touching base with them frequently to make sure that, you're not missing out on an opportunity? And I'll give you a perfect example, Jason. So MIP reduction comes out, right? And the first thing everybody thinks is like, well, hey, what good is that going to do? I mean, people are at 2 3/4. I'm not sure the MIP being reduced is really going to help that person. And when I had a conversation with a couple business partners, like, you're absolutely right. Like, it probably doesn't make financial sense. You should still call them anyway. Have a conversation with them, because guess what? They might be getting ready to sell their house in 4 months and you don't even know it. So you get the new one.
Right.
So use anything at your advantage in the marketplace to pick up the phone and call your borrower. It's your client, right? At the end of the day, have a conversation with them, stay in touch with them. You may pick up a loan from it.
Yeah, I think that's right. I mean, I always say, the world's going to keep turning. People's lives keep changing. There's going to be more people, growing up and wanting to buy a house. There's more people turning 30 every day than we've had in a long time, right? It's happening and it's coming. And I think your point's, well put. It's any touch point is a good touch point, and you never know, and things change. Just like you said, right? They could even be thinking about buying another house, and all of a sudden, they've been watching this one neighborhood, and there's a house that pops up, and they're like, let's pull the trigger on that. And they're like, oh yeah, I just talked to John last week. Right? Let me give him a call and see where rates are at. Right. So it's those little things. I think the little touches that go a long way. And I'm a huge fan of local lenders. I've used brokers myself in the past personally. I just think, lending is always going to be that local level.
So I think we've touched on all. There's a couple questions on jumbo that came in, but I think we touched on that. There was some conversation around rates, and we got to this last slide. So I think we kind of touched on that with size of the market. I would say there's two things we should probably touch on that have come through in some form or fashion. And I know you're going to find the first one shocking that this is coming through.
Oh boy. You want me to guess? No.
Yeah, guess. I'll give you a guess. What do you think it is?
I'm just kidding. I don't know. What is it?
It's ARMs, the conversation around ARMs and why we see the pricing that we see on ARMs. And if you don't mind just touching on that real quick.
Yeah. So the best way, I guess the easiest way to kind of think about this is ARMs are short-term money. And if you think about what the Fed is doing, they're trying to cool the economy down. They're raising short-term rates faster than the long-term is keeping up. And so if you look at the yield curve, when we say inversion, right? If you look at the 2-year treasury versus a 10-year treasury, there's quite a spread there. A 2-year is paying actually more money than a 10-year. And that's the indication of the market of, like, once again, rates will come down in the future. But right now, the economy is just so hot. And with an 8% prime, these shorter terms are just going to have higher rates, and they don't make sense. And so when you might see, the random credit union or a small community bank, for whatever reason, might have a smoking rate temporarily on a 5.1 or a 7.1. That's not tied to the market, right? That's tied more to internal hurdles. I can't really speak for them, but we see it occasionally once in a while, and we're scratching our heads like, why are they doing this? But it's out there, it happens. But in the macro sense, it just, there's no lift there. You really need that, in my opinion, you need that 50 basis points in rate kind of spread for people to really start to look at ARMs. And it's the opposite right now. It's the Fed driving that short-term rate higher to slow this whole thing down. And unfortunately, ARMs fall into that category, right? I think depending on the 5, 7, or 10, historically those durations are 2 to 5 years, 2 to 6 years, maybe that, not even that. And there's just nothing there right now. There's no bid.
Well, it's interesting you say that, right? Because I know you and I have worked together at here and our previous employer for probably 16, 17 years now. And it's funny how many times we see that, right? Where there's the credit union or bank that has a smoking ARM price. It's there for a moment in time. They fill up the coffin again for whatever the motivation is, and then it gets turned off. That's more of a transaction that they're buying that particular market for a reason. That's not the norm.
Yeah. There could be there could be a reason for that. There could be not a reason. There could be a model problem. I mean, I hate to say it, but this business is still a little manual. I mean, it's especially at your smaller shops, smaller credit unions or banks, they might have one person that is setting the rates, and maybe they're setting them once a week, and the market moves on them, and they're not around to reset the rate sheet. So there's a lot of different factors that could go into that.
Yep. All right. Hey, last question. And I kind of think you might have known we were going to get this question. I'll just kind of summarize it because it came from a couple different people. and it's around the recent events in the banking sector, right? And kind of what, if any, impact do you see around those type of events to our business partners from a mortgage perspective, how it affects their business? Obviously, we had, some of the banking, what I guess was labeled as the banking crisis that took place here recently. Thoughts around that big picture into mortgage, into our business partners and impacting them?
Yeah, I mean, well, there's a lot going on there. There's a lot to unpack. Yeah, so high level, I think the regulators failed us in some way. I think they knew there were some issues for a while, weren't addressed or weren't addressed quickly. We fully expect the regulatory pendulum to swing pretty hard, and the hammer will come down. From our perspective, I actually personally sit on the liquidity committee here. I mean, I think we do a really good job of stress testing our bank, and we're very conservative when it comes to that. And with the recent events and our acquisitions, in particular of Signature Bank, our ratio of assets and deposits is one of the best out there. So, I think we're a very strong counterparty when it comes to that, and looking forward. If you read the next shoe to drop could be commercial. It's hard to tell where that's going. There's some resets going on coming up on some of the commercial real estate in the country, depending on if people come back from the pandemic. I think more and more you're starting to see people come back. A lot of people are back either hybrid or full time. Most of Wall Street's back full time at this point. Most banks are back at least 3 days a week, maybe 5. So, will it go back to pre-pandemic levels? I'd probably say no. My guess would be no. But will it go back to 90% of what it was? Maybe. So I think it's a little overblown, because when it comes to commercial real estate, I think there's a lot of negotiations and structures that can be put in place to help maintain a liquid event with one of these guys that owns a big building or a multifamily or something like that, where you can structure it to meet the needs and still have a decent ROI for the bank. So I kind of take these articles with a grain of salt. I think there's going to be a little bit of pain on some of these, maybe some of the smaller mid-sized banks that really went deep on commercial, but I just don't see that happening in a maybe a systematically wide issue. So for us, I think it's there might be some posturing. Some guys might exit. Some guys might get out of TPO altogether and focus on retail footprint, go back to basics, right? I think we're seeing that now. I think we've had some of our, I don't know if you want to call them peers or competitors, at least scale back or pare back on TPO. I think, for us, Flagstar, our DNA has always been TPO. The bank was founded on TPO, a 30-year tradition. I think we've talked about this before, and not to toot John's horn, but it's the tenure on the staff, especially on his leadership team in the sales area, is just unrivaled. 20, 30 plus years. So I think for us, you get the experience. We try to give you the best product suite we possibly can. We're working on some new stuff that's coming soon. So I think it's a strong partner that has the product suite. We might not always be the best price, but we try to be at least in the mix. And we try to do the best job we can. And I know that our sales reps, once again, I'm here. I'm not just saying it. I think they're some of the best in the biz. They work with their partners on a partner level. It's not a one size fits all, right? Where a lot of places that I've been where we've sold to counterparties, it's, I get the same thing that John gets, even though I'm different in different ways. I think we do a really good job of focusing on that customer, what matters to this customer, and how can I help them price to their markets and what they need to achieve the success.
All right, man. As always, good information. We'll make sure your AEs have the 6 or 7 pages Jason put together for today. We'll get that out to you upon request. Whenever you want it, let us know. And Jason, man, hey, I appreciate it. Thanks for doing it. Good information. Good looking at kind of why we're in the position we're in and where we're headed. So think there's a lot to be excited about. We just got to, kind of get there.
Yeah, no, I agree. Thanks for having me on, and appreciate your time and everybody on the call, and all the business partners are on the call. Appreciate all of you as well.
Yep. Cool. Thanks, Jason. Appreciate it, man.
All right. Thanks, guys.
All right, gang. Hey, once again, certainly appreciate you carving out the time, whether you watched it live or you watched it as a replay and you watched it over time and you went back to it. We appreciate you carving out the time. As you can see, just trying to bring value above and beyond the relationship of actually just doing transactions, which I think this is maybe our 23rd or 24th one. Hopefully you took some value away from this. And then next month, we're actually bringing Joe back. We got such a positive response to Joe's, both here at Flagstar and Joe himself personally, where a lot of our business partners reached out to him, that there's a couple things we're looking into, not for this session, but I'm actually looking to partner with Joe to bring something of service and value to you as our business partner. So look out for that here in the future. But Joe, we did such a good job, I think Joe did, of kind of showing how you could use social media to find referrals, to target them. But then at the tail end of last time, he wanted to get into like, man, I want to show him how to create reels and let's go. And that's how you should do this. So I kind of hit him up and I was like, well, hey, look what the response you got and we got. Let's come bring you back on in May. And let's walk through that whole session. Like, let's get people comfortable with using the cell phone at their hand to create a reel. And this is how I do it. So Joe's going to come back on. We're going to dive right into that on May 11th, and we're looking forward to having him again. So, look, guys, as always, can't say thank you enough for viewing this in some form or fashion, but more importantly, can't say thank you enough for your partnership. We know you have choices. We know we need to earn your business, and we try to do that every single day. So, certainly appreciate you and everything you do and your partnership with us. Make it a great day. Have a good one.